For investors like myself who specifically invest in securities with higher yields, the most concerning issue that we have to watch out for are potential dividend cuts. A dividend cut can be more severe than a stock's share price falling for a period of time, because not only do some dividend investors live off their distributions, but a dividend cut can also mean that the company we've put our hard-earned money into is crumbling, at least for the short term. And in one sector in particular, we've already seen dividend cuts all throughout 2022, with a few companies seeing very sizable declines in revenue. And given how inflation is still an issue, it's very likely that some of these companies are going to continue to see their dividends be cut all throughout 2023. The first stock we're going to take a look at, which is definitely getting a dividend cut this year, is Annaly Capital Management, ticker NLY. They're a diversified capital manager that engages in mortgage financing. Annaly invests in agency mortgage-backed securities that are collateralized by residential mortgages, non-agency residential whole loans, and securitized products within the residential and commercial markets. They're one of the oldest mortgage REITs in the sector, having been founded all the way back in 1997. You can see their stock currently offers investors a massive dividend yield of over 16%, which is so large for any individual company that it should be a red flag for investors. Mortgage REITs typically offer much higher dividend yields on average compared to other dividend stocks, typically around 8 to 12% on average. So at 16%, it's a pretty concerning thing that they've got going on. A couple weeks ago, this company held their fourth quarter earnings call, and needless to say, the board was less than optimistic about 2023. David Finkelstein, who's the current CEO of Annaly Capital, made the following statement, quote, "I wanted to make one last point as it relates to earnings available for distribution. While we generated earnings available for distribution that covered our dividend this quarter, we witnessed the moderation discussed in recent quarters, and we anticipate some further pressure on earnings available for distribution going forward. As a result, subject to determination by our board, we expect to reduce our quarterly dividend in the first quarter of 2023 to a level closer to Annaly's historical yield on book value of 11 to 12%, which compares to the approximately 16% yield on book we are paying today. We believe this will allow us to appropriately manage the portfolio within conservative risk parameters, which also deliver a more sustainable yield that is competitive with the peer set and broader fixed income benchmarks, which have always been our objective." Just by looking at their financial results, we can see things have kept getting worse for Annaly over this past year. Even before 2022 and really the pandemic, this company was struggling. We can see over the last 5 years, their stock share price has collapsed 48%. Going back even further, we can see Annaly's lost almost 3/4 of its value since February of 2008. Their 10-year dividend history is also an ugly mess, which as we can see, they were originally paying $1.80 per share per quarter compared to just 88 cents today. The company gives this really handy metric in their financial highlights, which is earnings available for distribution. Over the last year, you can see this amount has kept moving downward, with them just barely being able to cover their regular quarterly dividend in December. It's really unfortunate because for the longest time, Annaly was a pretty great performer. Between their IPO in 97 and until early 2008, this company surpassed the S&P 500 in terms of performance. You can see it provided an average annual return of 15.15% compared to the market's 5.36% over the course of that 10-year period. The company is still the largest in the industry today, with total assets exceeding $80 billion. So we have to ask, what's been behind this company's downfall along with some of their peers? The two most important numbers we have to look at here, in my opinion, are going to be interest rates and the book value for these REITs. Most mortgage REITs experience negative performance during periods when interest rates are really high. The reason for this has to do with how these mortgage REITs are regulated. Because all REITs are required to pay out 90% of their earnings to shareholders in the form of dividends, this doesn't leave hardly any room for growth. So one way these companies typically grow is by borrowing money so they can buy more investments in mortgages and other real estate securities. But with interest rates so high, this greatly reduces the amount of profits these companies can get. If you're borrowing money at a much higher rate, then obviously you're not going to collect as much net income from what you're using that money to invest in, because you're paying much higher interest rates on that borrowed money. The second reason has to do with a company's book value. This is the most important metric for a mortgage REIT on their balance sheet. The book value for a company is basically the total value of all the company's assets. Basically, if the company were to sell everything that they own, this would be the book value. Because REITs own mortgages and other real estate securities, a falling book value over time means they're holding fewer and fewer mortgages and fewer investments. And if they're holding fewer and fewer mortgages, this means there's going to be less money to be made from a smaller portfolio. There's several things that can cause an REIT's book value to fall that would take a long time to go over, including prepayment risk, principal risk, and so forth. But if you remember anything about book value for REITs, it's that sizable long-term declines are almost always going to be bad. Just by looking at Annaly's book value over time, we can see a huge decrease in just the last 2 years. In June of 2020, they had a book value per share of $33.56, whereas last December, it was all the way down to $20.79. It actually recovered a little bit between September and December, but given the statement made by the CEO, it obviously wasn't enough to protect the dividend. Let's take a look at some other companies in the same sector that could also be seeing some difficult times ahead. ARMOR Residential REIT, ticker ARR, is another mortgage REIT that does a lot of the same stuff that Annaly Capital does. They invest in residential mortgage-backed securities that are backed by government-sponsored entities and the Government National Mortgage Administration. Just like with Annaly Capital, ARMOR Residential's book value has also been collapsing over the past few quarters, and they've kept recording losses. At this rate, the company and its dividend are going to keep deteriorating unless by some miracle things get substantially better for them. Their stock currently offers a huge 17% yield, but don't let that fool you because there really isn't a point in time where investing in this company would have left you with a profit. Going back to their IPO in 2004, even with those massive dividend payouts you would have received, you would have lost a substantial amount of your investment regardless if you chose to reinvest your dividend distributions. My advice would be to stay away from this company because I don't think that dividend is going to be safe where it's currently at. Another stock that looks like it's headed for even more trouble in the future is Orchid Island Capital, ticker ORC. Just like with Annaly and ARMOR Residential, this stock also offers an insanely high yield of almost 17% according to Google. And they're also very similar in terms of what they do, which is investing in residential mortgage-backed securities on a leveraged basis. Plus, they pay monthly dividends, which is also the case for ARMOR Residential. But look at Orchid's book value throughout the quarters. Their book values collapsed by more than half in less than 2 years, going from $27.30 in December of 2020 to $11.42 in September of 2022. Just like with ARMOR, I'm also really concerned about how stable this stock's dividend distributions are going to be going forward. To give you some examples of some better REITs that are more stable, let's start by taking a look at Starwood Property Trust, ticker STWD. Despite being a mortgage REIT that invests in mortgages, this company also invests in physical real estate, making this company a hybrid REIT. If we go over to their book value on their balance sheet, we can see a very consistent number throughout the past few years, and it even jumped in December of 2021. Their dividends have also been really stable throughout the years, and you can see that they've never had to reduce their dividend distributions. Although their stock only yields around 10%, it's been significantly better than what we've looked at so far. Let's take a look at one more example, which is Blackstone Mortgage Trust. They're another REIT that offers a yield of over 11%. Just like Starwood Property, we can see a very consistent trend in terms of their book value. It normally stays between $26 and $28 a share. Now, their book value doesn't offer any growth and therefore less potential for a dividend increase, but if you like income stocks like I do, then getting an 11% yield on your money is a pretty darn appealing thing. Also, take a look at their dividend history over the last 10 years. Not a single cut anywhere for this stock. For some reason, Seeking Alpha's chart isn't correctly showing this information as it's showing cuts, but Blackstone's website and Nasdaq is confirming that these cuts didn't actually happen. In summary, based upon what we've looked at, I think we can only expect more difficulties for Annaly, ARMOR Residential, and Orchid Island Capital. While we know Annaly is definitely going to get a dividend cut this year, I think it's also extremely likely for the other two companies that we've looked at because they're basically doing the exact same kind of business. Anytime you see a stock that's offering a yield of more than 10%, it means you really need to be careful and do your research. In all my years of investing, I can't think of a single time where a stock offered a yield of more than 15% and it actually sustained it for many years. As I've mentioned in previous videos, not all mortgage REITs are bad companies, but I'd say the majority of them are either bad or mediocre. Good REITs do exist though, which is why you should always perform your own research and due diligence before making any investment decision.